Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, October 18th, 2022. It is 11:21 a.m. Eastern Time as I'm starting the video, and what I'm going to do in this one is rifle through a bunch of charts. I'll go through them relatively quickly, each one, but I want to give you a comprehensive look at the indexes on both the stock futures and the tracking ETFs. That's SPY and QQQ. We'll stick to the large caps in this one, and I'd like to run through at least some of the top sectors in the S&P 500, show you where we're at because we're at some significant levels, and then finally the top components of the NASDAQ 100, which are also top components of the S&P 500, because again, as I continue to state, we have the most important earnings week by far next week. We have Apple, Microsoft, Alphabet, Amazon, Tesla, or is Tesla the 19th? Tesla's tomorrow, I'm sorry, but then next week as well, Meta and NVIDIA. And so those are all in order as I just read them out, the top holdings in the NASDAQ 100, and again, most of those are the top holdings in the S&P as well. So to say next week is a potential market moving and pivotal week would be an understatement. So we're going to look at those charts. I always say this quite often, but not always. If a chart, we can often determine where a stock's going to go after earnings based on its technical setup, if it's clearly bullish or clearly bearish. And of course, I'm going to point out levels to watch and potential developments to watch for. I'm going to start out here with the futures, and we're going to look at ES. I'm going to make sure I cover SPY and ES here because remember, NASDAQ 100, although it's my preferred trading proxy for the indexes, it's not the only index. In fact, a lot of traders trade the S&P. So we're looking at now a 60-minute chart right here of ES. This is an uptrend line off the lows, and it's a very well-defined uptrend line. We had the initial reaction, that's the bear market low right there recently, and then numerous reactions right here where it was crawling up that trend line, and we just hit it. So I continue to favor a bounce. We're actually, I'll get to the NQ chart in a second. I gave you two on the chart I got out to this morning, the 10-minute chart. I gave you two areas where the bounce was likely, or really a small range, and we're at the lower part of that range now. Now, what you're looking at here, however, is a bearish rising wedge. We have negative divergence on the PPO. You can see that right from there to there. That gives us a rising wedge pattern. So something to monitor for sure, and also a little divergence of that most recent thrust up there on the RSI. So 60-minute bearish rising wedge on SPY. If it breaks down, obviously that's going to be bearish. Next and first support is about 3660 right there on ES. And then, as I talked about earlier, if and as each support level is broken, it gives a check mark for the bearish case. And at this point in time, the fact that we've had the recent recovery, remember, here's SPY or ES. We went below that recent low from late September there, danced on it, broke down, had that was when the hot CPI came out, solid recovery, another successful test. So let me just say this. ES has absolutely no business taking out 35.76 right now or 35.75 to keep the bullish case alive. At best, it might want to come in and back test. Now, look, anything's possible. This market's full of whipsaws, but from a technical perspective, that level should not be violated. And if it is, then it opens the door, I think, to a powerful wave of selling. So that's how it looks on the 60-minute chart. Those are your levels to watch. Obviously, the trend line right here, which is so far, has been a pretty aggressive fade of the rally. Remember, hopefully I did a decent job in trying to impress the importance of the fact that, hey, that analog from 2008, the same point with the divergences, is it likely to play out exactly that way? No, but it certainly could, as I said earlier, and that's why I wouldn't spend all that time pointing it out. And the takeaway is, don't worry about the exact percentage bounce here. Like so far, we're a little shy in the NASDAQ 100. I think we did 9 point something off the recent lows. That one was about 10. But the important takeaway is failed bullish developments, such as the recovery back above the recent lows. Let me just jump back to a little bit longer here. That's the 3-month. Let me just go to a 6-month here on ES so I can be comprehensive. Okay, there's the previous bear market low from back in mid-June, and so you had a couple cut throughs there and recoveries. The divergent low, positive divergence, and we're above it now. So until unless that fails, like I said, the check mark goes to the bulls today, absolutely. And again, on a more micro level, smaller, when you jump down on time frames like I like to do, that's the level that would be a pretty much a pretty heavy get in short moment if that gets taken out, and all in if the recent lows get taken out, because that'd be a new bear market low, and that would be about as good a check marks as you can get for the bearish case. It would mean this whole breakdown and recovery above the recent lows has failed. So watch that wedge. I expect a bounce here. I mentioned that on last post I got out to you. Let's look at NQ. Or no, we'll look at NQ and then we'll go to SPY and QQ. Okay, NQ, this is a 60-minute chart. I can take it back a little bit here to 3 months and show you there's our primary downtrend line right there, which is still a potential target. Nice support here at about 11,100 right there, which we're back testing right now. Uptrend line support below to boot, and the minor downtrend line, which we're back testing. So there's a confluence of support, and as I said earlier, this is where, quote unquote, the bulls should be stepping in and buying this fade of today's gap up. It's been a pretty aggressive fade, but then again, it was a very aggressive gap up. We're still positive right now. This is great support, and if they don't step in here and you start going through, especially that trend line, and then the line in the sand for me right there, you can see it about 108.21 in NQ. That is very important support, and then really all that's left after that is the move to the recent lows. So if this happens, whether it's after another bounce or not, anything down here really gives check marks. That's like my all-in heavy aggressive short. That's where I think that we'll finally get the I'll use the word market crash. I'm just referring to a very powerful and swift and unrelenting move down, kind of like we had in 2008, sort of like we had in COVID, or exactly like that. We haven't seen that yet in this bear market, so I'm showing you the levels to watch. As of now, the bulls still are in control. This is just nothing but a pullback after we've already recovered those levels, so it would take more downside to undo what's happened today. We're getting close, but not there yet. We're still up positive, not by much, but still positive in the Nasdaq. It is worth noting that there weren't a lot of follow-up buyers on this breakout, and again, I caution that it's earnings week. Take everything that happens with a grain of salt. On one end, yeah, you take a breakout above a solid resistance level, especially very impulsive. You have to take it on face value to an extent, but also know that it's likely to get undone depending on what the big fangs do, big tech companies do next week. So there's your levels to watch. Hopefully that's, makes sense. I'm trying to give you levels to watch, and if you're an active trader or even a swing trader and you want to just kind of build your case check by check, then here's that 60-minute chart, or 10-minute of NQ I got out to you this morning. And this morning I had two trend lines. This one, which I ever so slightly tweaked. This is where I had it, the bounce coming anywhere from this trend line down to this one. And now we're at that one. By the way, this is a more significant, this is what I call a minor trend line, the smaller of the two with less reactions, and more the primary trend line off the lows. So where this was decent support, this is better support. And this morning, that's what I showed you. I expected a reaction here, a reversal, pull back because of the negative divergence. I told you this 10-minute time frame has just been printing money for me for months now. Not every single one plays out, but when you get these trend line breaks or divergences, then you start looking for sell signals, or in many cases I'll just short a divergent high into resistance, especially when you're in a bear trend, bear market. Likewise, you buy pullbacks to support, and or when you get divergent lows, you buy breakouts above downtrend lines and things like that. Of course, you gotta watch the economic calendar. That's why I have it on the site. There are two things on the resources link up top, takes you to the right side of the chart support center, and there's under the tools of the trade, I have the earnings calendar and the economic reports. I access those. The economic calendar I access all the time throughout the year, several times a week, to know what potential market move and reports are coming out. So if you knew CPI is coming out, well, you're going to have some volatility and maybe some whipsaws that day. Now we're in thick into earnings season. You would be remiss not to pay attention to which companies are reporting and which ones report in the morning before the market opens. That's usually your banks, which we're pretty much got a few more financials coming in, and the regional banks, but for the most part, most of the big banks are now out of the way, or will be by the end of this week. Then you have big tech tomorrow. Banks tend to report before the open. Tech tends to report after the market closes. I'm going to go over those dates for you in a second. Bottom line is we are at support. I still expect the bulls to step in here because when you look at it, let me go to a daily chart now. This is SPY, the S&P 500. We're on a daily. And again, you can here turn off all the lines so it's not so busy. Keep it very simple. There was our previous major reaction, bear market low mid-June. Sliced through it a little bit, lost it, but then recovered it with a bullish engulfing candle, the big giant green candlestick. And as I mentioned, just because it wasn't confirmed the next day doesn't mean that it was invalidated. It's only invalidated if you undercut it. Then it cannot be a bottoming candle because there's a new lower low. So technically, even if you reverse, it's still not considered the bottom. So now it's been confirmed. It was yesterday, it was actually slightly confirmed because you closed above the top of the body of it and you took out the high intraday. But you were also at resistance, mainly on QQQ. But today it's 110% as of now validated. Now we can dump into the close and this candle can turn red. I don't think it's going to happen. I told you I'm buying this dip and reversing to short to long for the reasons I just showed you on the short-term charts. But that's what we're watching right now. There's, you can see some resistance coming up here. You've got price resistance at 381.25, a downtrend line, some reaction highs. And all in all, nothing but bullish price action today, and which now confirms what happened last Thursday, that bullish engulfing. So I'll take it on face value as of now, but I am very, very much open to the fact that because remember, the primary trend right now, let me just measure it for you. We are off the lows, off the intraday lows, we're up about 7.8%. But we are in 110% right now, still in a bear market. Only time will tell if this was a bottom on Thursday, but we're down to, 27% off the high. So this is, at this point in time, nothing but a bear market rally, and that's why you take it with a grain of salt. You recognize these bullish developments, recognize they have the potential to be either the bottom or at least a bottom, meaning a tradable bottom in a bear market rally, which is at most what I think it is now. But, trust me, if we're going up here, just because I'm saying I think that now, and this is what the S&P is going to do, I'm not going to be short that whole way. Hopefully, I'll be long most of it. At this very point in time, I'm long, especially on my active trading accounts, what I'm referring to, active trade off that 10-minute chart. Let me see. Okay, 60-minute chart. Here's what it looks like on SPY. Remember the divergences that I've been talking about for the last couple of weeks. Still confirmed, little whipsaw. We took out this minor downtrend line, and there's some nice support right here, 369.12. So this is even intraday a hard buy moment for me right now. I'm pretty aggressive long because I started laying in where I should, that top pullback range on NQ I gave you this morning on the 10-minute chart, doubled up on the way down to that lower range that I gave you on the 10-minute chart. This is the one I'm talking about, by the way. This is the 10-minute chart I got out to more. See the range. That shows that I expect to either bounce here on that trend line or that one. That one also comes in with the nice 145, 146-ish support. That's where we're at right now. That's the same trend line. I don't believe I tweaked it. Oh, yeah, that's right. It came in because I had the arrow drawn to coming not so fast on the way down. Expected a little reaction there. But still, we're right at that trend line now. And again, I showed you support on S&P. However, we start taking that out, then we go negative. And then you have a pretty nasty thing that happened, that gap up being faded. If you look at it on a 1-minute chart, and this again, if that's not a lesson to not use, to just monitor, be cognizant of, just know what happens with stop loss orders like I talked about earlier, order imbalances, and see they faded most of that. Let me show you. Well, you can actually see it here on the 1-minute chart. You can see how much that was at level. Remember, we were pushing against it was resistance recently, and so resistance once broken becomes support. So I'll say the fade is a little more aggressive than I thought it would be, but it's, well, not more aggressive yet, but it's right down to, again, what I just showed you, to about as far as I thought it would go to this trend line here. So much below that, Then you start looking at the daily and the 60-minute charts, and you also recognize that this market it's been decades now since high frequency trading and algorithmic trading programs have evolved, and artificial AI and everything. They go in, they know where the stops are, so they're going to usually run it down just beyond that point, clear a lot of the stops, and then turn around and buy the shares themselves. So at this point, like I said, it's still bullish. And where does it stop becoming bullish? Again, if we fall back below that, there was a lot of confusion because I had a bunch of typos in that first post I got out to, but I did correct those. I read the comment section. Thank you. Yeah, 269 really. We go much below that, and again, much below it. Wow, a lot intraday, or a decent amount on a closing basis. Because one thing that this market's taught us in a bear market, intraday volatility is very high right now. So you can pop it only to see them close back above it. So again, anything a solid daily close below that, and then the way it works from there, you just go down to the intraday charts and look at this. Here's your support levels. Again, where bulls, quote unquote, should step in and buy. They should right now. Absolutely. Remember, 269 was a big level. We're right there now. So they should buy. I expect them to buy. If they don't, that's kind of a rut roll moment for the bulls. But there's a big old gap here. They're going to try to test the bottom of that gap, or the top of the gap would be your first support. The bottom of the gap would be your next support. Then you have that reaction low, and then it gets thin. The only thing between there is that. And that means this whole thing was a breakout. So welcome to a bear market, guys. Whipsaw number one, false breakdown. And then if this fails, that's whipsaw number two, failed bullish recovery and breakout. And I think at that point, like I said, I think the bottom will fall out of the market. I'm going to get to those sectors and key stocks in just 1 second, but let's not forget what I covered the other day, the old volatility indexes. I covered a lot of things, sentiment indicators, volatility indexes. This is the VIX, the VIX daily chart here. Okay, so as I covered the other day, the VIX is at very significant, or it had, I'm sorry, when I covered it, took out downtrend line resistance, the primary downtrend line, and had this minor trend line resistance right there, which is pretty good too. You have 1, 2, 3, 4, several there, 5, 6, 7, 8, multiple reactions on that downtrend line, and a very big level there around 37.60, we'll call it 38. It's capped all the advances in the VIX, which were corrections. Really, the only time that it got there was back there. That was COVID. And if you roll back, you go to my weekly chart and you look at the long-term chart. This goes back, we just rolled back decades here into the 90s. We've had, by most metrics, or most want to call it, 2 bear markets, 2007 to 2009, and then when COVID hit. COVID was a 35 or 6% drop in the S&P 500. This one was a 55 or so, 56% drop. And look where they ended. So this is where bear markets end, not here. Corrections end here, and that's why I've been adamant that best we're looking at a bear market rally, and the bear market's not over. And then if this whole recent breakout fails, then and the market's about to take that next leg down, then you can expect the VIX to explode along with it. And you get up or around that level, and if my put to call ratios and all my other sentiment indicators, they start firing, and I have some positive breath indicators, especially sometimes those come after the bottom's in. This is a big one, capitulation. We have not seen capitulation yet. As much as the Nasdaq's down 35 or so percent, whatever it is, there's just been no fear. It's been an orderly sell-off, which really, with all the fundamental issues and the huge surge in treasury yields and the U.S. dollar and in pension funds and the gilts breaking over in the U.K. and God knows how many other things that just haven't surfaced yet. Private equity funds not being marked to market yet. I know that's coming. Our pension fund mess. It's all coming. It's just a matter of when are they going to surface? A lot of those things can be hidden for a long time, not reported, not recognized on their books, and so again, this is like I've said recently, the risks are bilateral. We can have an explosive rally too because the price action, as long as we hold this breakout, is bullish. And then what happens is no big deal. We're still in a bear market. The VIX is still elevated. We'll just have an abatement in the VIX. It'll come back down, maybe all the way to this trend line and support level, and the market will rally. And then the next leg down in the bear market comes later. that would be, you know, very, very likely. So that's what it looks like short term. VIX Apple. Apple's reporting next week. I told you this chart here. Look at that. This is big resistance going back years here. Here's your year marks: 2018, 2017, 2019. And the only other time Apple really got below here, there was a big drop. That was this was COVID, and this was another correction afterwards. But other than that, you can see, for especially in recent years, this has capped all the advances in the Apple volatility index. That's Apple is so big it has its own VIX. It's like so big it has its own zip code. This is the only stock I know of that has its own volatility index. Maybe there's others. Okay, on to the sectors. I'm going in by market, not by market cap, by weighting, weighting in the S&P 500. This is also the top sector in the NASDAQ 100 by far. It's about last I checked, about a 0.25% weighting. Remember, there's 11 sectors, so when the top sector has a 25% weighting, that's big. And again, it's about 50% in the NASDAQ 100. And so what I wanted to show you is, yeah, we can play glass half full or glass half empty. Glass half full, strong positive divergence, or yeah, strong divergence. Much lower lows on the prices and higher lows on the indicators. Positive divergence. Last time we had positive divergence was right here. That's when we hit T3 on a weekly, pivoted, closed all shorts there, and started going long. Rode up the rally, or the bulk of it, and started shorting at the 200 days. I started at the 200 simple, added all the way up, and was heavy when we hit the exponential is where I started, the red line, and then was all in short, you know, up to that 200-day simple. And then you had a very clean, it was just a beautiful setup. That's a bear market rally. Powerful, very profitable to trade, but just as profitable to get out and then reverse short. And now here we are. So my point being, that was the last time we had positive divergence. We have it here again. So we could be looking at another bear market rally, or this could be a redo of this point in 2008 where the divergences crap out. Good thing is, I'm pretty sure you're going to know by the end of next week, because here we go. Apple, Thursday, October 27th after the market closes. I'm talking about earnings. Microsoft, Tuesday, the 25th of next week. After the market, all these are after the market closes. Alphabet, Tuesday the 25th. Amazon, Thursday the 27th. Tesla's tomorrow. Meta is the 26th, which is Wednesday, and then Nvidia the 23rd, which is Wednesday. Those are all the top components. We're going to look at each of those charts. And so until then, expect some volatility back and forth. Trading might be frustrating. That's why I'm kind of, right now tucking into the world of those intraday charts, 10 minutes and 60 minutes. But I also keep an eye on the dailies. All the better, if you get, let's say, a pullback and then positive divergence on the 10-minute chart, let's just say, and you're falling to support or a uptrend line on that 10-minute chart. But at the same time, let's just say hypothetically, don't disregard what you see here. Let's say there was big support on the daily. All the better to go long if you have support on the daily chart as well, because daily charts always supersede the intraday charts, in my opinion. Okay, but what did I want to show you? Well, here it is. There's that previous low on XLK, the tech sector. Basically, we're back testing that now. We haven't recovered it. So this shows me that tech has been lagging the rest of the sector, and it's not a clear recovery yet. We did have the break below the June lows here, followed by a recovery. 3 candles, a little island there, island cluster, and then you gap down. You have gap on both sides. Now, island clusters are reversal. Island cluster tops like this are reversals, but they come at the end of an uptrend. You really don't. They're not continuation patterns. But take it for what it is. You do have a bunch of gaps right here, and then that previous low, which we're still in close enough proximity to say that it has not been recovered. We have positive divergence. Look again. The bulls are set up here to tee off. They've got a beautiful shot. The setup is there. If the market likes whatever big tech is selling next week, then they're all clear. You have all clear to run, a big run. Otherwise, if they don't, and this just, even if you get a little move above here before then, again, take any breakout between now until after all those big things are reported. Take it with a big grain of salt, because they can and will alter. They have the potential to alter the technical landscape, to override bullish setups. If for whatever reason doesn't, and again, it doesn't matter if they beat expectations. Please, if you listen to nothing else, do not read anything into whether a company beats, whether they give rosy guidance. It's all about what the market, how the market reacts. Apple is notorious for topping on blowout earnings, beating expectations, giving rosy guidance. It's just the nature of that stock. I've seen a lot of tops put in. Likewise, I've seen bottoms, and that's just an old saying in the market. It's always darkest before it's dawn, always darkest before the dawn. And usually a lot of stocks or the stock market, they bottom on horrible news, not on good news. So all I'm trying to say is, give it a little time, wait a day or so after the earnings are out of the way, and this market's going to tell you which way it's going to want to go. Unfortunately, if it's going to go up, it's going to probably be very fast. And by the time, and I'm sorry, I'm not giving you a clear what to do kind of thing, because if all those earnings, it's going to be incremental. You've got the first two reporting on Tuesday, and then a couple on Wednesday, and then Thursday. And that's how it's going to work. So if you wait to the end of next week, we could be all the way up here, or we could be all the way down here. We'll take it day by day, guys. I'm going to show you the levels, and most importantly, when you watch the futures, you can have those levels even if they're taken out overnight. And yes, you're going to be subject to more whipsaws over the next week or so. So, hey, there's always a benefit. If you don't know what to do, stand aside. Wait for earnings season to be over. Let's say we do this. Okay, so you're not nailing the top on the kickback rally, but you can always get in here, because at that point, I think there's at least another 10% down. Wait till I get to NVIDIA and show you, reiterate my long-term targets. And I have a lot of stocks with those aggressive downside targets, so I'll get to that one second. Let me just show you healthcare sector. That big white shaded box is just healthcare has been bouncing around in this range here. We had two breaks to the bottom, recovery, two breaks to the top, and we're back into the trading range. And it also hit a primary uptrend line right there. Healthcare had a long-term primary uptrend line, which it just hit. So it's at support, like everything else. Positive divergence at the recent lows, rallying off those divergences. But if it breaks that low, it'll also take out long-term trendline support. XLF financials rallying, but look, just like tech, I just showed you tech, a big sector, big support right here. I've had this line here forever and a day. This was T2. This was from the original short. If you recall, as a long-term trend short, we shorted financials back here, hit my first target, went up, never exceeded a reasonable stop. We went up and just made marginal new divergent highs that never violated a 3-to-1 risk-reward ratio of targeting these targets. So I maintained that trade. And then we went on to hit my third target. It was big support before. I'm sorry, in T2. T2 was the better support. And you can see boom, 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 gap there, boom, resistance, support, multiple tags. And that's where we're at right now. So on the flip side, we're coming off a divergent low. The price action's been strong lately, but we're at significant resistance. In other words, it's big check mark if the bulls take that out, and if they get rejected, then just a pullback really isn't a huge check mark. It's certainly a check mark for the bears near term, but the biggest check mark is going to come if this whole rally and these divergences peter out, and we go on to take out the divergences and move to new lows. I just wanted to show you where we're at. And if the rally sticks, look, we're probably going to. I keep showing you trend lines on the indexes and the 200 days and big resistance. This was big support. That's why I had a red line right there, 35.33. So that would be my bounce target right now if we're going to continue up. And that's about another 8% swing target, if you will, for the financials. But again, first things first, they're at pretty significant resistance. They need to get past that. And if not, maybe that's it. All right, we're not going to do each and every one of them. The common theme is just about every sector and all the indexes had this positive divergence. There's some minor resistance here. This is XLC, communication sector, or this is just Facebook and Alphabet. That's all it is. I'm sorry, Facebook and Google. They make up almost half of this sector here due to their big weightings. So we're going to get to those two in a second. I'm going to show you the FAAMGs. XLY, consumer discretionary. We had first of all a downtrend line, a little bullish falling wedge, bear market rally, number one. Then the divergence, we put in a marginal new low, even bigger divergence, even bigger rally, ended with a bearish rising wedge. and then broke down, and here we are with yet an even bigger divergent low. See, you just draw the line. So the potential's there for big rallies, maybe even beyond the 200 days. I can tell you, as I said a week ago or two, this is the most bullish setup I've seen in years. And that doesn't necessarily mean it's going to play out, but it doesn't mean it's not. It's the most bullish setup, and that's all. If the setup fails to materialize like it did back in mid 2008, that's going to be extremely bearish. When you see such a beautiful bullish setup fail to materialize, it shows you the market's broken. All right, won't do any more. There's XLI, industrials, big support right there. But here's what I wanted to show you, the big FAAMGs, because that's what it's all about next week. Let's just go to those and then we'll wrap the video up. I'm going to show you 2 time frames. We'll start with the daily. Here's Apple. Most significant thing lately, there was a downtrend line which was taken out today. You had RSI divergence right here, so positive divergence, and a pretty big support area right here. You can see the reactions in the past here. It was a reaction low, reactions there. We broke it, but then recovered it. Same thing, another whipsaw through and another recovery. So Apple tends to fight for this level here, about 138, 137. And on a weekly chart, you could probably see that a little bit better when we go to the weekly chart. Worth noting, but is that, remember, just like QQQ and SPY, nearly every trend indicator is bearish, particularly the intermediate and most of the longer term trend indicators. Apple only spends time, a considerable amount of time, I'm talking days or weeks, below these blue and red lines are the 200-day or 40-week moving average is the same thing as a 200-day moving average. And Apple only spends time below there in bear markets, and it's still well below those lines. Other than that, in a bull market, turn off all the lines, you can see Apple, you buy pullbacks to the 200s in the 40-week on a weekly chart. But in bear markets, just like here, fourth quarter drop of 2018, that was a big bear market for Apple, dropped well over 20%. Other than that, most of the time it's below it. This was a bear market back here for Apple. I tell you exactly, we dropped 34% off the highs, and that was in mid 2015 to 2016, and you were below it most of the time. Then you recovered it and said, hey, get back in Apple. As a trend trader or an investor, and then buy pullbacks, and then get out when it drops below there. There was the last, no, that wasn't the last. Here was the last bear markets all the way back here, and you can see it was below there as well. So that's my point here, is a lot of these trend indicators are still bearish, so they haven't flipped yet, and we're still in a bear market for now. And yes, my current bear market target remains about $82 and or the primary. That's the long-term uptrend in Apple. I know some chuckle and say that's an insane target to see Apple go from 200, whatever, almost 200, 185 all the way down to 82. And if so, if I'm right, it's going to take a while to get there, but it would be a 54% drop. And Apple last bear market was 62% drop in Apple. We had a 42% drop there, and an 82% in the dot-com burst back in 2000. So to me, a very doable target. I know to most analysts, especially the folks who come on TV, they just couldn't even fathom Apple going there. But I'm a believer that, you know, even in a bull trend, things come back to the mean, you know, and the mean here is this long-term uptrend line. Microsoft on a weekly chart, you know, there's your primary uptrend line. See, these are all, I believe, will be visited before this bear market, which I believe is still in its very infancy. You know, and again, there'll be rallies along the way. We'll zigzag down. But right now, we're at good support. 280, 228, 229 right there. Why is it good support? That was major resistance. This is a weekly chart. These were weekly candles. Boom, boom, boom. We were pushing up in this little triangle pattern. Broke out, successfully back tested for a few weeks, a couple months even, and then boom. All right, so we're there now. There's positive divergences like just about all the market leading stocks because the indexes have it. Of course, if the indexes have it, your market leading stocks will have it. But you're below all the key moving averages. You're in a bear market, and in bear markets, support levels get broken. Sometimes you get a nice tradable bounce off them, and sometimes you slice through them like they're not even there, usually after at least a brief pause. So we'll see. Time will tell, but there's Microsoft. And the takeaway now, why am I doing this? Again, you can see on the daily too, that's also, there's the support level. This is what you want to watch for after earnings. Anything below here, bad. It's going to take Apple down to the next level most likely. That next level for me is 199. I'm going to light it up for you. So we're going to watch these after earnings. You can watch it in the after hours session. Remember, don't read too much into the initial reaction, but if you see a big 10+% down in Microsoft or Apple, and it doesn't get bought up that day, it's probably going to stick, okay? Because it's going to take you below the lows. So those are levels to watch. Next one up is, I got to reload my QQQ so I can get my watch list. Alphabet. Again, it's the same story over and over. Big positive divergences on this daily time frame, on the weekly time frame. Nice clean trend line. We had a little whipsaw, false breakout, but now the real deal. We've broken out of the falling wedge. Some minor resistance here and really big resistance there at 105. That's why I don't think this one in particular, I don't think it's going to go very far before earnings, because you have pretty big resistance at 105. It's possible, and it's not just the bottom of this trading range. It's boxed in here. That was a very significant range. We broke to the bottom. Support once broken becomes resistance, and it was also the top of this trading range here as well. So big level to me, 105. And okay, what's the takeaway? Again, after earnings, if we can take out 105 on a solid closing basis, especially on a weekly basis, that's going to be bullish. And then once you re-enter these trading ranges, you usually go to the top of the range, at least the midpoint. Oh, you're usually going to find resistance around the initial tag of the midpoint of the range, but it would likely carry up to the top of the range. That would mean, if so, Alphabet has about 18% upside. If it gets rejected here, can't go through there, and especially again if this divergence fails to play out, well, Alphabet, just like those other big fangs, are going to my long-term trend lines, and it's quite a bit lower, and it's probably going to happen very fast. That's the takeaway. I told you guys last week I thought we'd get resolution this week, and I'm sorry, my head was a little up my keister because of the whole hurricane thing. I should have, at that point in time, recognized and communicated to you that, hey, the market's really not going to pick a big direction until the FAAMG report. It usually goes into a holding pattern that week when all those big top components of the NASDAQ 100 and S&P report. These are the ones that I'm covering right now. So, yeah, it might be another week before we have a clear idea, or another week and a half, really, until they're out of the way after Thursday evening would be the last of them. Couple more and we'll wrap up the video. There's QQQ, and I gotta go back to my list up here. Okay, so next up is Amazon. Amazon, unlike the rest, never undercut. They had big support here. There was a previous low. Remember, we bought that low each and every time we hit it. I highlighted that as a strong buy. It was one of my favorites. We traded this rally up, sold it there, recycled back in. But we never hit that level again, 101.45. On the weekly chart, you can see it here. And so here's what I have on Amazon. This is what it looks like to me. This is a big one too. Divergences are not the be-all end-all, but they're a pretty big thing. And most of the FAANGs, just about all of them, but this one have divergence on the daily and weekly. This one doesn't because it never made a lower low. It's so far made a higher low. What I can see in my mind's eye now, maybe because the rest have it, they rally. But if they don't, and this one craps out after earnings, first and foremost, would be a break of this 103 support level. Those recent lows would be bearish. And if so, you'll probably get a quick thrust down all the way here to that 83.35 target. That's big support as well. It was this trading range here. And you can see how I have the lines drawn. That would give us then a divergent low on Amazon. The only problem with that is that it would probably take out the divergence or negate the divergence in the remainder. And Amazon's only one of about 7 I'm covering here, these top components, and it could also take out the divergence in the indexes. So anyway, I just wanted to say that this is not one of my favorite. I mean, you could view that as relative strength, the fact that it didn't undercut the recent lows like the other ones did, but this to me is a stock that's in a downtrend. There's a 200-day / 40-week moving averages right there. You can see since we broke them right here, every back test, 1, 2, were rejected, and so that keeps right now that trend indicator is pretty bearish right now, or this chart. It's in a bearish chart. And a couple more I wanted to show you, and we'll wrap it up. Tesla, this is my weekly chart. A maybe trend line right here that just got broken. But this is certainly a primary trend line. That's where I think we're going. That comes off the lows in 2019. And that's another roughly 39% lower. You do have, like just about every other FAANG besides Amazon, you have potential positive divergence, not been confirmed here yet. But you're also below the key moving averages, and we're in a bear market. So there's a decent chance, close to 50-50, that we're just going to go down here. And again, it's probably going to be all the FAANGs together. Either these divergences play out now over the next week or two, we see them firmed up and confirmed, and we get that nice rally up to these downtrend lines, and there's your target in Tesla. If that happens, Tesla could rally up all the way up about 50%. Even the 200-day moving averages come about 23. Otherwise, it craps out, and we'll see. I'll give you my odds by the end of this week, or well, certainly next week. We'll know we'll know after they report. Two more, and then we're done. Meta, former Facebook, like everything, just keeps diverging. These are my divergence lines. Just drag the lines. It's just like football. You get a first down, you move the hash markers, the first down markers. I'm moving the divergence lines until I can't move them anymore. I can't move them once we go down and we take out the previous lows. But as of now, we still have positive, aka bullish divergence. And look at this one, at a major reaction low. This is the major bear market drop. It was a 44% drop off this divergent high back in 2018 into the late 2018 lows right there, right at the end of the year. And we just kissed it the other day, and you kissed it with positive divergence. So you have Meta down off the highs, already a drop of about 68% down to major support with positive divergence. So again, the ball's in the bull's courts right now to take this and run, and it could be a pretty powerful rally. Otherwise, if it doesn't materialize, they break this support, especially on a closing weekly basis, we take out these divergences, that's nothing but bearish. There's your chart, your daily chart. Look at that nice big positive divergence as the stock is at long-term support. There was a previous reaction low here on the daily, which we're testing right now. So if we can get back above there, then this whole break of that previous low right here was a bear trap, false breakdown. And then Meta would come up here, first target, second target, and so forth. And last but not least, NVIDIA. Positive divergence like everything else, one of the leading chip makers. And I told you I'd talk to you about this chart. So this is NVIDIA. I beg you to find anybody out there that made a call back here in the beginning of the year that NVIDIA would fall all the way down to the 116.34 level. This stock, again, one of the leading chip makers, has fallen almost 70%. And so I'll show you this. Got this one right here. Here it was. This chart was posted on February 3rd. So early in the year, we had just broken down. I gave you three targets, 157.27, I gave you four targets. T4 being the 21-year-old primary uptrend line, but here's T2, 116. Here, I'll move it over for you so you can see it. If I can grab it, there you go. 116.34, and that was then beginning of the year, and this is now NVIDIA 116.34 just hit. So what does that mean? Not just that call has panned out. Here's how you work. You come down, you broke down, you back tested, you hit T1, you bounced as expected, you bounced again. Then once you took it out with conviction, you went down to the next target. Odds favor a reaction, but not as much as here. Okay, why? Well, okay, so I tell you I list multiple targets because each level is where a reaction is likely. So a long-term trader can cover short there. You would have made from the sell signal I gave you would have been, you would have covered that short for about a 41% profit. You would have sidestepped at that point. The initial reaction was a bounce of about 26%. So you would have been very, very glad you covered the short, even if you were holding out for this target, because you could have recycled back in, right? And you had another test here, the 200s. But where I'm going with this is, we have some major long-term sell signals triggered. We're in a bear market. And so what tends to happen is in a bear market, you reach that point at some point, we haven't hit it yet, where you have just waterfall selling, capitulation. And so quite often at some point in the latter stages, once a bear market's well underway and recognized by all, you have forced margin call selling, you have longs that start to capitulate. And so we have had a reaction already. A reaction I define as a consolidation and or a bounce when you're heading down. So 1, 2, 3, 4 weeks now trading on that level. And my point is, yeah, positive. Well, no, the divergence has now been taken out. Actually, see, I want to point that out. No more divergence. We just made lower lows on the PPO and RSI. And look, they're going to report next week. I would not be surprised, and tell you what, I'll almost give it equal odds that it craps out and we head down here. If NVIDIA heads down to my next target, which I have the highest degree of confidence it will, it's just a matter of, is it going to hit it in the next couple of weeks, or is it going to take a few months after the market and NVIDIA and the semis make a bear market rally? And maybe that happens in the sometime early next year, first, second quarter. Right now, I would lean towards it disappointing and falling down there. If that happens, let me tell you what it will mean to the semis and to the market, because tech is the biggest sector in the NASDAQ 100 and the S&P 500. Tech is everything now. The semis are the canary in the coal mine for the tech sector. When the semis are weak, it's showing you problems in to come in the overall tech sector, even if tech is doing okay at the time. So if I'm right, and we're going to T3, that's going to be another 38, almost 39% drop from where we're at today in NVIDIA. And if I'm right on my bear market target, which is T4, which is down around 32.69, and or the uptrend line, because see, as time goes on, uptrend line comes in at higher and higher levels. So we could go like this, come down, hit T3, bounce, and then ultimately get there later. Let's just maintain, and T4, it means the first up. When I say the primary uptrend line or the price level, as of now, you know, if NVIDIA gets there, I'd be looking for signs to cover shorts in the semis and or I'm not short this one right now, but if I was, that's where I'd be looking for it. But that's a pretty aggressive downside target, and to me, it's just a return to the mean. There's our primary, since the stock came public back in this chart goes back to the 90s here, late 90s. And everything ultimately comes back to these long-term trend lines. We got so far away from it because this is the biggest bubble ever blown in the history of the world, this Fed bubble, this easy money cycle, easy money, especially since the last bear market here. And it just sent asset prices to insane levels because there was no alternative. It forced money in the stock. So I believe those are very realistic targets. And the final takeaway, and I'll leave it here, this has been a very long video, is whether we break these support levels and this next leg down begins very soon, as in next week most likely, if it's going to happen, or we get that bounce that right now is priced in the charts. It favors the bulls at this point in time. We get a bounce could last weeks to months, but ultimately we're going to, I believe, go down here. And if NVIDIA is headed down even to T3, it's not going to do that with the stock market, with it going up. The tech sector will not be rising, most likely if the leading, one of the leading or the leading chip maker has another, what was it, 30+% downside. So there's your levels to watch. And again, the whole takeaway is I gave you support levels. We're at those support levels now. You can go down and get a little granular, go down to the short-term charts. 60-minute chart looks constructive for NVIDIA right now, like most charts. So markets are indicating a bounce, and I gave you the pullback targets in the beginning of the video, which we hit. There's the S&P 500, there's NASDAQ, right on cue. There's my max pullback target, there's the bounce. Now this is first resistance, 11,234. But I think we'll probably continue on up to what I gave you in the last update, this one right here, and then probably get a pullback there. Oof, okay, I need a break. That is a 49-minute video. That may be a record for me, but these are the times you either make a lot of money or you lose a lot of money, and if you don't know what you're doing, best to stand aside, because I wish I couldn't make such a strong bullish case at the same time for making such a strong bearish case. Unfortunately, I can. But like I said, I think by the end of next week, when the fangs are out, we'll know which way the market's going to go. As of now, the bulls are in control with what's happened today, so that's what I'm trading at this point in time, especially my active trading account. And if that changes, I'll let you know. But I'm speaking more to the this video is more to the trend traders and investors. All right, guys. This has been Randy Finney with Right Side of the Chart. Have a great day.